Welcome back to Palisade Radio. This is your host, Collin Kettell, and I'm here in North Eleuthera again with my good friend David Skarica. This is the first time we've done a video interview, so this is David. He lives in Eleuthera, and he's kind of pulled out of the system living in Canada and the U.S. He's been down here about 7 or 8 years, and it's just a beautiful place. To our left is the Atlantic Ocean, and to the right is the Caribbean. I'll put some pictures up of that so you can see, but welcome back to the show, David.
Yeah, thanks for having me here, Colin.
But before we get started, we talked about doing a giveaway. You have a new book. Well, it's actually came out a few months ago, but it's called Collapse. And this is David's older book. A lot of people might know about it. Sold about 40,000 copies, so very successful book. And his new book, Collapse, talks about the coming collapse that's going to come in the market, in the Dow, a lot of overvalued stocks, and how to take actionable trades based on that. And David's going to be giving away 100 free copies of that book to our subscribers. All you got to do is you go to palisaderadio.com. There's only 100 copies, so it's going to go quick. You go to palisaderadio.com, type your email in the top, and we'll flip you over a PDF version of the book. So thanks a lot for doing that, David.
Yeah, that's no problem. Because that book is just kind of the reason I wrote that book, just to kind of get into that, is that this super cycle book is like my big long-term 10, 15, 20-year picture or whatever. And that book was more that when we had this huge run in the markets since about 2011, where we haven't even had a correction and the Dow is doubled in price, etc., I started to get really worried about the market's valuations. So I decided to write this kind of smaller book, which kind of talks about that in detail.
Okay. All right, well, let's jump right in. We want to talk about stocks and bonds today because they both are at critical points as far as you're concerned. A lot of people don't realize this. They know the Dow's been going up, but you've managed to identify for your readers some stocks that actually they look parabolic. They're looking like they're ready to blow off. And let's talk about a couple of them in particular. Nike, you've been talking about. Netflix. What's a couple of the other ones?
Well, Disney would be another. Philip Morris would be one. And then I also look at the airlines, and in particular, I think actually Alaskan Airlines, which is one of the smaller carriers. The chart is absolutely off the charts, completely crazy, like completely parabolic. So there's obviously Netflix is kind of the typical tech overvalued deal, similar to 2000 the dot-coms. You have kind of these hot names. But I think what's really more interesting are the Nike and the Disney kind of trades. And I actually have another company that we're short. I haven't shorted those yet, which is actually a supermarket, which has gone parabolic as well. So with those trades, it's just really interesting because these are like companies that for 20, 30 years have just been on these kind of slight uptrends and the whatnot. Now these companies are trading at 29 and 21 times earnings and don't really have much in the way of dividends and have essentially tripled and quadrupled in the past 2 or 3 years. So I think what's happened is because the central banks have crowded people out of the bond markets. You're not getting any yield. So people chasing these kind of big, large cap names. And, when we kind of go back and look at the last 20 years, you circle the big move in stocks in the late 90s. You go, that's the tech bubble. In the mid 2000s, you circle that. And you go, that's the real estate bubble. And I think with this one, we're going to call it like the central banking, like zero rate bubble or something like that. And what we're going to see with this one, in the 90s, it was tech stocks. In the mid-2000s, it was home building stocks. And now it's going to be just these mainstream big names where I think we're going to see these charts go like this, essentially, because they're unsustainable. Remember, a little bit of a backup in interest rates, that all of a sudden Nike and Disney don't look as appealing, and that's how they can really, really, really tank. And remember, I just talked about their valuations. Philip Morris is the same way. You have all these companies trading at 20 times earnings, and these companies should be trading at probably 13 to 15 times earnings. So boom, that's 30% right there. And then if you take into account that margins are artificially high due to such low interest rates and companies' ability to borrow cheaply, and then that goes right to the bottom line. So those margins, they come back into historical averages too. You're talking, these stocks, it may sound crazy because they're big, large cap names, but these stocks can easily come down 50, 60% or more when you finally get a bear market.
Yeah, well, let's talk about the airlines in particular, and I'm going to put up as we speak here a couple of the charts that you've showed me. Southwest Airlines, American Airlines, probably Delta a little bit, and you mentioned Alaska. The charts are just, they're up 60-70% in the last 2 years. And of course, the price of oil coming down as a major input cost to the airlines has boosted potential earnings. But when a chart goes parabolic, from your historical perspective, what happens? I mean,
you actually, the saying is all parabolic curves collapse. And even if the story is good, like for example, I had a Chinese internet thing I was looking at last year that went from 20 to 100 in like a year, and it right now is at 65 and went under 50, so it fell 50%.
Yeah.
So it usually doesn't matter what the story is really. Like the thing is when the story is too good to be true, it usually is. So. And when you have a parabolic curve, you've priced all of that into the stock's price action.
Right.
And one argument I made on the airlines, I've been bearish on them for roughly the last year or so.
Yep.
And I've taken gone in and out of the short positions. But my big argument was, especially after oil collapse, was look at one of these air carriers is going to start cutting rates to be competitive, because they all had the same rates they were using at $120 oil and fees and all. And finally, American came out and said that they were going to start cutting rates to compete with Southwest and the smaller carriers, Spirit, the discount carriers, right? So once that happens, then you get in a price war, and then the margins shrink. And even with low oil prices, that kind of perfect story is gone. And like in the case of Alaskan, the stock has gone from like $3 to like $70 in 5-6 years, which is absolutely insane again for an airline. And the valuations front is they are generating a lot of cash flow right now. But we look at the price to earnings of these things, okay? And typically airlines at the top of a cycle will trade at like 5 to 10 times earnings. The reason being is everyone knows that E can evaporate quickly. Like all of a sudden you get a recession, the planes aren't as full, oil can spike, and they go from making money to losing money really fast, right? Not making less money, losing money. So usually they tend to have very low multiples. But you got stuff like Southwest trading 25 times earnings. Same with Spirit, right? Because they are growing a little faster than the average airline. But that just means a lot of air is built into them and can kind of evaporate. And actually, there's something else here. It's an interesting psychological thing. Is that there's a guy, you've had him on your show, but who is a resource fund manager.
Yep.
And he started airline ETF. And and in the 90s, it's nothing disrespectful. It's just that in the 90s, I remember all the Vancouver mining guys doing .com deals. That was like 99, 2000. That was right at the end, and that was it. That was the top. So I just kind of think that kind of thing is like a sign that it's getting frothy when someone is really not in his area is getting into something else after a huge run. That can also be signs psychologically of a top in the market. It's a great vehicle because like at some point you have something to short kind of the whole sector, in my opinion.
Yeah. No, it's a huge contrarian indicator.
Yeah.
Potentially.
Potentially, yeah. So
let's step back a little bit, talk about the market in general. The Dow, I think it just made a new high the other day. And what's going to lead, and what are you seeing that makes you think we're leading to a crash? Maybe, I don't want to say September, but sometime in late fall or early next year.
Well, if you actually look at major stock market bear markets, other than maybe 1962, which was during the Cuban Missile Crisis, right? They always, for whatever reason, happen during the fall. That was in June. That one happened. Right? There was a big dump in the market. So for whatever reason, it tends to happen in the September to October time frame. But I don't know. Right now, I think we're in the topping process. Like I've told you, if you actually now start looking at the market, the Dow is right where it was in December. So in 6 months, it's gone nowhere. When you have a lot of bullish sentiment and the markets start churning and not really going anywhere, I consider if the market's up 2, 3, 4% in 6 to 9 months, it's not really going anywhere. So the same kind of thing happened with the gold stocks in 2011. Was that everyone was bullish on gold, and gold was almost 1900, and then they took almost a year to top out before they started to fall in 2012. So I'm not saying we're going to take a year, but it wouldn't be surprised me if the topping formation lasts into the summer, and then we kind of move lower. What I think will trigger it is that first of all, we see record stock buybacks right now, right? Like this month in May, there was an estimated 140 billion of of announced buybacks, and usually about 80% of those get filled, and that was the biggest month ever. And that puts a buffer under the market, right? So I think at some point a decline has to send the stocks lower enough, first give it a bust, where then companies say, well, you know what, our stock options are too far out of the money, we're not going to buy back stock, right? So that takes a big buffer out, and I don't know when that correction starts, but this is where I get into maybe I kind of have the time frame down. In July, we're going to have our quarterly earnings reports. And if you go look at the earnings estimates this year on the S&P, it's expected to grow by 4%. Well, it shrunk in the first quarter, probably the first 2 quarters of this year. All of the gains are backed into the fourth quarter, right? It's like, I think I think like 70 or 80% of the earnings gains are all estimated in the fourth quarter. Well, if these companies start reporting at the beginning of the third quarter, and say, we don't really have much clarity in the next 6 months or so, I think that is when you can start to see the market sell off, because it's going to be obvious there's no earnings recovery coming, and the market is basically, I think, trading as high as it is based on we're going to see a recovery in the second half of the year. And if you go look, the last real times we had corrections, like 2010 and 2011, that is what happens, is that the market sold off during the spring and summer months because it was obvious that the economy was slowing and the recovery in the second half of the year wasn't unfolding. And I think another trigger event for it into the summer and the fall is recently see, and this is actually kind of a segue to what we're going to talk about next, a backup in yields in sovereign bonds all over the world. Like the German bond, which was almost zero, it went to 0.06. It now is about 0.5, 0.6% on the 10-year. The U.S. 10-year, which was down about 1.7, is up to about 2.2. And the Swiss bonds were negative are now back in positive. The Japanese bond has gone from 0.2 to about 0.4. Yep. So we're seeing this backup. So I think right now it's not a big deal because they're coming at such low levels. But if you see, say, another doubling in yields, the Germans goes to 1, the Japan goes to 0.8, the U.S. maybe goes to 3%, that is when the markets can start running into problems, because these bubble stocks that we talked about, like, again, Nike, Disney, one reason they're moving like they are is that they're seen as, hey, I'd rather own Nike and Disney even at inflated levels if the 10-year yield is 1.8%. Well, if the 10-year yield is 3%, or the Japanese bonds are blowing up or something, all of a sudden those investments don't look so appealing. Yeah. So that bond market bubble plays into the potential trigger for a stock market sell-off.
Yeah, and they're very, very tied together. Let's talk, since we've segued here, about the Japan trade. And I think every single interview we've ever done, we've talked about this, but there's a reason. And you and I think it's one of the best trades out there for the bonds. And before I turn it over to you, I do this every time, but I want to explain it real quick. Our buddy Trey Canepa has a group called Kenai Capital. It's managed accounts. You deposit $30,000 in the account. You got 5-year window, and he's burning through about $500 a month. He's buying short-term puts on the 10-year bond yield. And if the Japan bonds blow up to 3%, 5%, 10%, you get so in the money. And I don't want to talk numbers exactly, but you're talking millions of dollars from $500. And I know a lot of your subscribers are in this. A lot of people I know are in this. I'm in it. You're in it. So talk to me about it.
I'm also setting up a small hedge fund where I'm going to put like 1% of the assets of the fund in that trade, because it kind of becomes like a black swan event. Maybe similar to like Kyle Bass shorting CDSs back in, or buying credit default swaps back during the financial crisis, right, in certain entities. So I think that's the whole idea for it, is that Trey actually got the idea from Kyle Bass. Yeah. He saw him on TV and basically said, Bass is like, I got the one trade right now, and it's the biggest no-brainer in the world. And the no-brainer is Japan's debt to GDP is 230%. Which is basically, by the way, 100% higher than Greece was, and it started its debt crisis. Greece was 130, right? So you've got this 25-year bond bubble building in Japan. The central bank is out of control. They're buying the same amount of bonds the Fed was buying, but their economy is 1/3 the size. Right. So that would be like the Fed was buying $1 trillion a year. That'd be like the Fed buying $3 trillion a year, because the Japanese are buying the equivalent of $1 trillion a year. So the idea is, at some point, like, people might say, well, can't the central bank just own all the bonds? But the thing is, the bond market still trades day to day, and if just 1 or 2% of that bond bubble revolts against it, and what will happen is you'll see a slow backup in yield, and then if that yield gets out of control, then 1 or 2% of the bond market selling off is going to be really easy because people are going to be going for the exits big time.
Right.
So you're right. But anyway, what I'm saying back to the Kyle Bass is that you're looking for a trade that for the limited amount of capital, you can make a huge amount of money. And, like $500 a month, like for me, that's like selling one subscription a month. So you work a little harder to sell that one subscription and be able to do the trade. So that is kind of what we're looking at here. Something that has a huge amount of upside with limited capital. And for me, when I look at the sovereign debt bubble that I just mentioned, Japan is the country that I think will go first because it's the highest debt to GDP in the world. Their demographics are horrible, so their fiscal situation is not going to get better anytime soon. And it's just a question of when this kind of blows up. So another thing he's doing is he's also shorting the yen and going long gold in yen terms as kind of a way to hedge the trade. Yeah. So like what it is like this. Let's say the bond doesn't blow up, but the yen continues to sell off and gold goes up another 50 or 100%. So you'll also make money off that side of the trade.
Right, so he's betting that the yen against the dollar is going to underperform, which so far, as of today recording this, the yen's at an all-time low, or it's a recent time low.
Part of the argument for the bond going down will be once the yen starts to sell off a lot, people will want to get out of those bonds because they're like, I'm getting 0.5% on a 10-year bond, and the yen is going down 20% in 6 months, right? So get me out of here, because I want to sell the bond and get the money out of the yen. So that's also the argument for the sell-off in the bond. Of course, the bond part's what we're really, really interested in. But I just you got to look at the triggers. In 2000, just the dot-coms busted. In 2007 was obviously the financial crisis and all these mortgage-backed securities. And okay, all of the debt in the world has now been shifted to the governments. My recent issue, I talk about this, and what I show in my recent issue is that you look at all these countries around the world, like the States or Spain or Britain or wherever, most of them had debt to GDPs between 50 and 60%, right, before the financial crisis in 2007. Now they're all starting to push up against 100%.
Yeah.
So essentially their debt against the size of their economy is doubled, and so now the leverage is all going on the government balance sheet. So you have to think that the next crisis, the debt crisis, is going to come from one of these governments blowing up. And what's your Lehman Brothers a government? It's probably Japan, because Lehman had the most leveraged balance sheet, right? So Japan has the most leveraged balance sheet because they just have the highest debt level.
Right. Okay, well, let's segue into another big topic that you talk about and I talk about all the time, and that's gold. And I want to pose a question to you in a certain way. On the one hand, we've talked and we've said, listen, there's no way that gold and gold stocks are entering a new rally until we have some type of a sell-off in the general markets. However, on the other hand, you can look at Newmont right now and a few of the other majors, and you can say they've definitely hit their low. They're up 60%. They're showing positive earnings. They've managed to get their balance sheets in line, and a lot of times these bull markets and gold stocks start with the majors, trickle down to the mid-tiers, and then you get the explosion in the juniors. What do you think?
Well, I think that's a sign. I look at the charts of some of those stocks, and actually there's one that we know is the smaller producers that it's almost tripled off its lows as well.
Yeah.
And I look at that, and I think that tells me that a serious new low probably isn't coming. We're probably not going to see $1,000 gold or the HUI go to 120 or something like that. That is a sign. You look at Newmont's chart, there's no way that's going to a new low after the base it's made and the move that it's made. And, remember, one thing that really helps those large companies is, number one, the dollar going down because a lot of them produce in foreign countries.
Right.
And they're getting more gold, for euros or Canadian dollars or Australian dollars or wherever they're producing, and their costs are relatively fixed in those countries. And then oil is a big input cost. So,
of course, yeah.
So gold is essentially flat, say year over year, maybe slightly down, and oil's down 50% year over year. That really helps margins as well. And they've restructured. They've gotten rid of a lot of properties that are uneconomic. They're essentially just looking on keeping production steady and growing margins, right? And if gold prices go up, they're more leveraged now. The idea before and the big problem that companies made is that they just expanded and overpaid for assets, right? So that model's kind of out the window. So I think the sign of the outperformance in the stocks is, even though I've said that, I continue to say that you're not going to have a huge move in gold until you get a big crack in the U.S. markets, and then the Fed comes back with QE, and then then you get kind of you get an inflationary a spiral, right? And that's when gold can really move.
Yeah.
But I think that the stabilization and this technical strength of a lot of those stocks is a sign that we're getting close to the bottom. And by the way, you saw that, say, in the late 90s. I remember in the late 90s, some of the royalty companies, like Franco-Nevada, when it got taken out by Newmont, actually, was trading at all-time highs and gold was 300 because the company it was so well managed, right?
Yeah.
So definitely, because the company's now adjusting to lower prices, it just looks to me like the gold stocks won't have a huge decline going forward here, because it just looks like that they're acting well. A lot of them are acting well,
Yep. All right, well, let's kind of end it at that. If anybody's interested in the Japan trade, go to shortjapandebt.com. There's a lot of information there. I think Trey has his own newsletter. You can also reach out to me or David if you want to get in touch with Trey. And also, not the right cover to the book here, but this is David's last big one. And we're giving away the first 100 people that put their email in to the top of Palisade Radio will get a free copy of your book, PDF version of Collapse, emailed to them.
Yeah, and basically that's a lot of the things we touched on here. Actually, I also do have a chapter on gold on it, and says that, like, I think gold is bottoming, basing when the market tops. So, and we talk about, like, the valuations of stocks and that sort of thing, right?
Yeah. Cool. Okay. All right, David, thanks so much.
Thanks.
Good talking to you.
Nice talking to you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?